If you stop fundraising today, how long will your startup survive? 3 months? 1 month? Or are you already in free fall without knowing it? Most startups don't die from a lack of ideas. They die from a lack of time to fix mistakes. They don't calculate, don't cut losses, don't face reality. They survive on blind faith that money will always come until no one picks up the phone anymore. This is your wake-up call. The life or death line between a default alive and a default dead business. No one is coming to save you. No investor will stick around. Either you take control of your fate or you'll be swept away as if you never existed. And to survive, you must start with the harshest truth. Is your startup default alive or default dead? Part 1. The nature of default alive and default dead. A startup is either on a path to self-sustainability or racing toward death. There is no ambiguity, no exceptions. If cash flow and revenue are growing fast enough to reach profitability before running out of money, that's default alive. If not, it's default dead. This is a harsh truth, but it's also a compass that prevents founders from lulling themselves into beautiful illusions while neglecting a solid financial foundation. Knowing where you stand between these two states is the first wise move for any founder. Default alive doesn't just mean turning a profit today, but having the ability to ensure a sustainable financial future without relying on the next funding round. Conversely, default dead means your survival depends entirely on securing new funding, a risky and uncertain endeavor. This clarity from the start will save startups from countless deadly decisions. Default alive isn't merely about short-term business results. It's a long-term strategic commitment. It reflects the ability to build a company based on real internal strength. A company that isn't profitable yet but is exploding in revenue, rapidly cutting its burn rate, and has a long enough runway can still be considered default alive. On the other hand, high revenue with soaring costs and chronic losses is merely artificial survival, rotting from within. What's great about this concept is its brutal simplicity. It allows no excuses. There's no, we're building a brand, or we need more time. Either you can feed yourself or you die. A successful startup is one that faces this reality head-on, not one that spins beautiful stories to deceive itself, its team, and investors. Default alive is the true embodiment of freedom in the startup world. When you no longer rely on external capital, you can choose partners, set your own growth pace, and even reject unfavorable investment deals. This is the most powerful state any founder should strive to reach. A company that lives on its own cash flow writes its own future instead of surrendering to the brutal swings of the market. Understanding the difference between default alive and default dead is also a test of grit. It demands extreme honesty in evaluating financial figures. Founders must ask the tough question: if no more investment comes, what happens to the company? The answer, no matter how painful, will shape survival strategy. A truly strong company can survive without rescue. Default alive is not just a goal, but a way of life for a business. It requires ruthless cost optimization, continuous revenue growth, and strict financial control. A startup can't live on vague expectations. Only by turning every cent spent into real value can long-term survival be ensured. And only when it truly becomes default alive can a startup earn the right to dream of something greater. Part 2. Why startups push themselves into death. One of the biggest reasons startups become default dead is the illusion after a successful funding round. Having once gained investors' trust, many founders assume future rounds will come just as easily. They forget that each new round is tougher, demands more substantial achievements, and faces fiercer competition. This illusion is the knife that kills clarity. Social pressure and the always look strong mindset are also sweet traps leading to destruction. Founders fear being judged as weak if they admit financial trouble, so they keep burning money, pretending everything is fine, instead of acting decisively to protect the company. The fear of losing face delays hard decisions, prolongs a zombie state, and drains any remaining chance of survival. Misunderstanding the fundraising process is another common cause. Many founders fail to grasp that fundraising is not a linear upward path. Each round comes with higher standards, more solid financial data, and lower tolerance for risk. Without early preparation for these rising demands, startups collapse mid-journey without realizing why they failed. One-sided media coverage makes things worse. Media mostly features successful deals and huge funding rounds. Rarely do they report on failures or the startups that silently run out of cash and die. This creates the illusion that fundraising is easy and all successful startups follow a non-stop funding path. That illusion kills the clarity needed for disciplined, wise financial management. Unconsciously, many founders fall into a fatal mistake, equating raising capital with building a successful business. They see fundraising as an achievement instead of a tool to create real value. When the goal is funding, not financial autonomy, the startup traps itself in dependence and fragility. A truly strong business doesn't need investors to survive. It chooses partners, not begs for rescue. Part 3. Leverage, the power of true autonomy. A startup only truly holds power when it doesn't need capital to survive. When internal cash flow is enough for operations, the company breaks free from the chaos of external dependencies. At that point, the founder no longer seeks capital, but walks into negotiations from a position of strength. This is not just financial power, but psychological strength, making a visible difference in every strategic decision. And in investors' eyes, this self-sufficient stance offers two huge advantages. First, better negotiation on terms, minimizing risks of equity dilution or unfavorable commitments. Second, increased intrinsic attractiveness. Investors want to bet on resilient, pressure-free startups. Financial autonomy acts like a magnet, attracting the best resources and giving the company more options instead of being forced to accept any conditions. Real leverage doesn't come from pitching skills or personal connections. It comes from numbers that speak. Positive cash flow, optimized costs, sustainable revenue. It's built over months of financial discipline and even the smallest wise decisions. A startup with real autonomy won't just survive a brutal winter. It will rise stronger when the time is right. Financial independence is the sharpest sword and strongest shield in any startup game. Part 4. Silent conflict. Founders versus investors. Startups and investors rarely have perfectly aligned goals. Founders aim for long-term sustainability and building a solid business. Investors, on the other hand, optimize portfolios through explosive growth stories or quick, clean failures. They don't have time to nurture companies that are merely limping along. That's why investor advice doesn't always serve the startup's survival. Founders must be extremely alert to distinguish between helpful guidance and hidden pressure. If a startup trusts investors too much and loses its autonomy, it's easily swept into a whirlwind of unrealistic growth. Urgings like scale fast, expand aggressively, or burn money to grab market share may sound compelling. But without solid financial foundations, this is the fastest way to crash into the abyss. A smart founder knows when to listen and when to firmly stick to their own roadmap. The survival rule is this: listen to everything. Act only on what serves your survival. A founder must be a leader, not a people pleaser. They must build a company that can stand on its own, even without a single dollar more. No one else bears the consequences of their mistakes. When you're at the helm of a startup, surrendering control is equivalent to sentencing your dream to death. Part 5. Suicidal mistakes when trapped in default debt. The biggest mistake of a startup stuck in default debt is continuing to burn money as if things will magically get better. They hire aggressively, push advertising, expand offices, all based on the fragile hope of raising the next round. But the market shows no mercy for dreamers. If you can't survive on your own, each passing day only brings you closer to irreversible collapse. Another common illusion is hoping someone will acquire us. As cash runs dry, many founders comfort themselves with fantasies of a big company swooping in to buy them out. The truth is the opposite. Smart companies don't buy drowning startups. They wait for you to implode, then poach your talent cheaply or buy assets in liquidation. Hoping for a miracle only delays the hard decisions needed to save yourself. A deadly mistake is refusing to face financial truths. Founders who don't calculate runway, track burn rate, or understand customer unit economics are cornering themselves without realizing it. A strong startup is never vague about its financials. They know where every cent goes, how every dollar is earned, and act as soon as warning signs appear. This isn't pessimism, it's the art of survival. The worst failure isn't making a mistake, it's refusing to correct one. As runway runs low, many startups still blindly hope for miracles. They continue drawing unrealistic growth plans, continue investor outreach from a position of weakness. The longer the delay, the fewer the chances left. A bold founder is one who cuts losses quickly and shifts strategy in time to preserve the most valuable thing, the chance to live. Part 6. Survival moves to course correct. Once a startup realizes its default dead, it must act immediately. There is no time for hesitation. The number one goal is to extend runway. Every extra month alive is a chance to turn things around. All spending that doesn't directly create value must stop. Preserve cash flow at all costs. The faster you cut losses, the greater your chances of survival. Time is your most precious asset. In a crisis, every day alive is a victory to fight for. Headcount reduction is a painful but unavoidable step. Most of a startup's expenses lie in people. When survival is the top priority, only the essential team members should remain. Be decisive, not hesitant. Cut early, cut deep. Avoid being dragged down by bloated fixed costs. A lean, focused team will fight harder than a large, clunky organization. This is the time to prioritize the organization over personal emotions. Next is optimizing operational expenses. Every cost line must be reviewed. Office, software, marketing, external services. Non-essential spending must be cut immediately. Anything with room for renegotiation must be renegotiated now. Rebuild the most streamlined cost model possible. Every dollar saved extends the company's life. Pride or ego cannot be allowed to cloud judgment during this life or death phase. Finance must be the top priority. Raising product prices is also a strategy not to overlook. Though price hikes may shrink your customer base, improved margins can save your company. Focus on the segment willing to pay more for real value. Startups must bravely abandon the illusion of growth at all costs and instead build a sustainable model. A truly healthy company generates more value than it spends, no matter how slow its growth. The final, but most critical step is changing your strategic mindset. Shift from an explosive mode to a long-term survival mode. Accept that staying alive today matters more than any short-term ambition. Build a business model that can endure for years, immune to investor market mood swings. In a storm, the winner is not the fastest, but the most resilient, flexible, and enduring. Survive first, thrive later. Part 7. Real lessons from startups that survived. Startups that survive aren't luckier, they're braver during the hardest times. They don't deny harsh reality. They don't live in vague hope. They act quickly, cut what no longer works, and pour all remaining resources into extending survival. They understand that every short-term sacrifice is worth it if it buys one more day to live. The survival mindset is the most powerful weapon any founder must relentlessly forge. Time is the most precious asset a startup holds when crisis hits. A company with 18 months of runway can experiment, fix mistakes, and pivot. One with only 3 months has nearly lost the right to choose. Every extra month alive means renewed hope. Strong startups never let themselves fall into panic-based decision-making. They prepare for storms while the sun still shines. They build long runways not out of fear, but out of long-term vision. The final lesson, and the most profound reminder, own your fate. A startup must be built as an entity that can stand on its own, survive on its own, grow on its own. Don't wait for miracles. Don't depend on external salvation. Only initiative, clarity, and a warrior's resilience can carry a startup from death's doorstep to glory. Fight like no one else is coming to help. Because in truth, no one is. Not every startup is worth saving. To be honest, some models are flawed from the root. Some products have no demand. Some founders are keeping dead bodies on life support and calling it perseverance. Default alive isn't an ideal if what you're keeping alive has no future. Survival is only worthwhile if it leads to something greater. If not, end it quickly and start over sooner than others. Don't confuse grit with stubbornness. Don't trade your youth to cling to an empty name. Some failures revive you. Some survival kills you slowly, every day. Thank you for watching the whole video. Please like and subscribe to the channel so you don't miss the next videos.